Welcome to Iron Financial. Our mission is to forge stronger portfolios, and we do that by putting the market's biggest names through a brutal stress test. Today, we're taking a global titan, SBUX, and putting it under the microscope. Look, we're not interested in the froth, we're not interested in the flavor of the month. We are here to conduct a full structural analysis. We're going to check the foundation, we're going to test the load-bearing walls, and we are going to look for any cracks in the armor. Let's get to it. Now, on the surface, SBUX looks like an absolutely impenetrable fortress. I mean, let's be honest, it's way more than just a coffee company, right? It's a cultural institution, it's a daily ritual for millions and millions of people. With a storefront on practically every high street in the developed world, its brand is one of the most recognized on the entire planet. This is the kind of company that portfolio managers build their entire consumer strategies around. It's supposed to be the bedrock, stable, predictable, unshakable. But here's the thing, the market doesn't pay for yesterday's victories. It prices in future strength. And our job here at Iron Financial is to ask the really hard questions. So let's dive in. Is that unshakable foundation actually developing some fissures? Are there signs of stress that maybe the casual observer, the person just grabbing their morning coffee, might miss?
Whoa, hold on a second. We're talking about SBUX? The company that practically prints money with that green siren logo, the name that basically defines the entire premium coffee category. And you're telling me there's a genuine, serious reason to be concerned here? I don't know, that just seems a little bit unlikely. For a lot of people, this is a consumer staple now. People need their coffee, and they've proven time and again they are willing to pay a premium for it.
And that's the narrative. That's the story everyone knows. But our job is to test that story against the cold, hard numbers. So we're going to start with the outer wall, the most visible part of the entire structure, the top-line revenue. This is what tells us if the company is actually expanding its territory or if its growth is maybe hitting a brick wall. A healthy giant has to keep growing. It's that simple. So the question is it? Okay, this slide right here tells a really critical story about the company's momentum, or lack of it. For the full fiscal year 2025, consolidated revenues, that's the whole company worldwide, hit about $37.2 billion. Now, that's up 2.8% from the year before. Okay, any growth is technically positive, but for a company of this scale, that's barely keeping up with inflation. It demands a closer look. But the real alarm bell for me, the one that's flashing red, is right here. North America. This is the company's heartland, its most mature, most critical market. Revenue here grew just 1.3%. Let me say that again so it sinks in. 1.3%. All right. 1.3% is not a number you're going to write home about. I'll give you that. But it's still growth, isn't it? In their biggest market, no less. They're still adding over $360 million in sales. I mean, are we really going to call that a crack in the foundation? Or is this just the law of large numbers kicking in? You know, when you're a $37 billion behemoth, it's just plain harder to post those huge, sexy growth percentages. So is this a real sign of weakness, or is it just a sign of maturity? Is this a stable, high plateau, or is it the beginning of a long, slow decline? That, right there, is the billion-dollar question. That's a fair challenge. It's a very fair challenge. And you're right, top-line growth is only the first layer of this analysis. I mean, a company can grow its sales all at once, but if it costs them more and more and more to get each dollar of that sale, well, the entire structure becomes unstable from the inside out. So we need to move from the outer wall to the internal framework. We need to look at profitability. We have to talk about margins, because this is where the real story of operational health is told. And to really understand the health of the entire company, we have to put the primary engine under the microscope. For SBUX, that has always been and continues to be the North American segment. It's the cash cow. It's the part of the business that funds all the new ideas, the international expansions, the shareholder returns, everything. If this engine starts to sputter, the whole vehicle is going to slow to a crawl. So let's pop the hood and check the pressure gauges. And here it is. This is the number that should have any investor sitting up and paying very close attention. Let's look at the most recent quarter, Q1 of fiscal year 26, and compare it to the same exact quarter last year. In Q1 of FY25, the North American business had a GAAP operating margin of 16.7%. Now that's a healthy, robust, fantastic number. It means for every dollar in sales, they were keeping almost 17 cents as operating profit. Now look at the most recent quarter, 11.9%. That, my friends, is a catastrophic drop. The profitability of their core business has literally fallen off a cliff. In the language of finance, this is a decline of 480 basis points. Let's be crystal clear. This is not a rounding error. This is not some minor seasonal fluctuation. This is a 5-alarm fire in the engine room. To see this level of margin compression in your most important market segment, it is a massive, massive red flag. We're talking about a nearly 30% collapse in the segment's profitability rate year over year. Think about that. And just so we're all on the same page, when you hear analysts like me talk about BPSs or basis points, it's just a way to discuss very precise movements. A few basis points here or there, that's completely normal noise. But when you see a number like 480, you need to understand the magnitude of what you're looking at. That's 4.8 percentage points of pure profit that has simply vanished from their most important business segment. It's an enormous number. Okay, now I'm paying attention. For real. Let's forget the percentages and basis points for just a second. Let's put this in plain English for everybody. What this means is for every single latte, every frappuccino, every single breakfast sandwich they sold in North America, they made dramatically less profit than they did just 1 year ago. That's not a small crack. That means the profit engine is seizing up. It suggests that their costs, whether it's labor, coffee beans, rent, you name it, are spiraling out of control. Or they're having to discount like crazy just to get that pathetic 1.3% sales growth we saw earlier. Either way you slice it, the fundamental economic model of their core business looks like it's under severe, severe duress. Exactly. You've hit it right on the head. And that brings us to our next critical point of inspection. When a company is facing this kind of intense pressure, you have to pay extremely close attention to how they present their numbers to you, the investor. The real story a company is telling is often found not in the big, splashy headline numbers, but in the footnotes and in the adjustments. We need to look at the difference between what's officially reported under standard accounting rules, that's known as GAAP, and the adjusted or non-GAAP numbers the company would really, really prefer you to focus on. All right, take a look at the fourth quarter of fiscal 2025. According to the official rulebook, GAAP accounting, Starbucks' consolidated operating income was a paltry $278 million. That gives you an operating margin of just 2.9%. But then, watch this. The company adds back $618 million in what it calls adjustments. And poof, suddenly the non-GAAP operating income triples to almost $900 million, and the margin magically jumps to 9.4%. The gap between the official story and the adjusted story is enormous. So we have to ask the obvious question, what on earth is in that $618 million adjustment? And when we dig into the reconciliation tables, deep in their financial reports, we find the answer. The single largest item making up this huge adjustment is a charge of $755 million for restructuring and impairments. Now, this is the cost associated with major shakeups in the business. We're talking store closures, layoffs, massive strategic pivots. They are, in essence, telling you, the investor, hey, please ignore this $750 million cost when you judge our performance. Hold on, let me get this straight. The business is going through a massive, incredibly expensive restructuring. A restructuring that cost them over $750 million in a single quarter. And they are asking investors to just ignore that cost, to just pretend it never happened. That feels less like transparency and more like a magic trick. I mean, ask yourself this. Is a company that's firing on all cylinders undertaking a massive restructuring? Or is this a sign of deep, systemic problems they're frantically trying to fix, and then trying to paper over the cost of those fixes with some fancy accounting adjustments? That sounds less like a strong foundation and more like a weak one being patched up with financial plaster. You are hitting on the absolute core of the bear case. You are. But it would be completely irresponsible of us to ignore the other side of the ledger, because while the operational profits are showing these signs of severe decay, Starbucks has one asset, one structural element that is so unbelievably powerful, it might just be strong enough to hold the entire enterprise up, despite the cracks we're seeing elsewhere. We are talking, of course, about their customer loyalty program. This right here, this is the company's moat. This is their fortress. In a world where consumer attention is fleeting and brands come and go, Starbucks has managed to build an ecosystem that locks customers in and creates an incredible, almost unbelievable level of predictable, recurring revenue. The financials of this program are, frankly, staggering. So let's just run through the numbers from the most recent quarter because they speak for themselves. First, let's talk about the user base. In the US alone, there are 35.5 million people who are 90-day active members of the Starbucks Rewards program. To put that in perspective, that is a population larger than the entire state of Texas, all actively engaged with the brand on a regular basis. Next, let's follow the money. In a single quarter, just 3 months, Q1 of fiscal 26, customers loaded $3.56 billion onto their Starbucks cards and apps just in the US. Think about what that is. That's effectively an interest-free loan from millions of their most loyal customers. It's cash sitting in Starbucks' bank account before they've even had to steam a single drop of milk. And finally, the impact, the knockout punch. These rewards members are not just casual customers. They are the core of the business. They account for an incredible 58% of all spending in U.S. company-operated stores. So more than half of their revenue comes from this captive, loyal, and pre-funded army of consumers. This is an absolutely incredible economic engine.
Okay, I have to admit, that is impressive. It really is. I can sit here and criticize their shrinking margins and their accounting tricks all day long, but you simply cannot argue with those numbers. That is their fortress. They have literally built their own private economy. Having billions of dollars of customer money just sitting there on the balance sheet, locked and loaded, waiting to be spent, that gives them a level of stability that 99% of companies out there can only dream of. It's a powerful, powerful defense against all those operational headwinds we've been talking about. It is a truly formidable asset. So that's it. That's the conflict right at the heart of this company. This is the structural tension we've uncovered in our analysis. On one hand, you have a business whose core profitability is eroding at an absolutely alarming rate, forcing it into these costly, messy restructurings. And at the exact same time, you have a customer-facing fortress that is arguably one of the strongest in the entire consumer landscape. So let's bring it all together for the final verdict.
So, the bull case, the argument for strength, is crystal clear. You have the iconic global brand that everybody on the planet recognizes. You have that unbelievably powerful loyalty moat we just detailed, with over 35 million active members and billions in preloaded cash ready to be spent. And we haven't even really touched on the potential for continued international growth, which is still a significant opportunity for them.
But the bear case, the argument for weakness, is just as stark. You've got collapsing profit margins in their most important market, North America. You've got stagnating, anemic growth in that exact same core market. And you have the company admitting, through its own actions and its own financial reports, that it needs to spend hundreds of millions, nearly $1 billion, on restructuring, which is just a fancy corporate way of saying, things are broken and we need to spend a fortune to fix them.
And that, right there, is the fundamental question for any investor looking at Starbucks today. This is the stress test. The company is, without a doubt, under siege. The forces of inflation, of competition, of changing consumer habits, they're all battering the walls of its profitability. So the final question you have to ask yourself is this. Is that incredible loyalty fortress, built over decades, strong enough to withstand the financial siege on its profits? Or are the cracks we've identified in the foundation, the stagnant growth and those collapsing margins, simply too deep, too systemic to ignore? That's the analysis. The decision is yours. Thanks for joining us at Iron Financial.